Your money is dying right now. While you watch this video, inflation is eating your savings alive, like a silent parasite. But here's the twist. That same money, if you understand the game, can become your soldier, fighting for you, instead of against you. Welcome to the financial matrix, where deposits and credit are not opposites. They're two sides of the same coin that can either build your empire or destroy it. Today, I'm pulling back the curtain on how banks really work, why your safe savings account might be a wealth trap, and how smart credit can accelerate your freedom, while dumb credit becomes financial handcuffs. This isn't theory. This is the machinery behind every fortune ever built. Meet inflation, the invisible thief that never sleeps. It's not a conspiracy. It's mathematics with teeth. Central banks target 2% annual inflation, which sounds harmless until you do the compound math. At 2% yearly, your money loses 50% of purchasing power in 35 years. But here's what they don't teach in school. The Consumer Price Index, or CPI, is a lagging indicator. It measures yesterday's prices, not tomorrow's reality. When housing, education, and healthcare costs rise faster than the official basket of goods, your real inflation rate might be 5 to 7% annually. Think of inflation as financial rot. You don't see it day to day, but open a time capsule of cash from 1990 and you'll witness the decay. A Big Mac cost $2.20 then. Today? Nearly $6. Your grandmother's savings account interest didn't keep pace. That's the tragedy of nominal versus real returns. Nominal is the number the bank advertises, say, 4% annually. Real is what remains after inflation devours its share. If inflation runs at 5% and your deposit earns 4%, you're not growing wealth. You're paying the bank to hold your depreciating money. This is negative real yield, and it's the silent killer of middle-class dreams. Banks are not warehouses for your money. They're factories that transform your deposits into loans for others. When you deposit $10,000, the bank doesn't lock it in a safe. They lend it to an entrepreneur buying equipment, a family purchasing a home, or a corporation expanding operations. For this service, they pay you interest, simple interest on basic accounts, compound interest on premium products. But here's the architecture you must understand. Simple interest calculates only on your principal. Deposit $10,000 at 5% simple interest, you get $500 yearly. Compound interest, however, is exponential growth. Same $10,000 at 5% compounded monthly becomes $10,511 in year 1, then grows on that larger base in year 2. Over decades, this divergence becomes astronomical. Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the math is undeniable. But deposits have a dark side called liquidity risk. That certificate of deposit promising 5.5% interest. Try accessing your money before maturity, and penalties eat your gains. High-yield savings offer flexibility but lower rates. The deposit contract you sign isn't just paperwork, it's a legally binding time prison. Read the fine print on capitalization periods. Daily capitalization beats monthly. Monthly beats quarterly. The frequency of compounding determines your real return. And then there's the liquidity paradox. Cash in a savings account loses to inflation but saves you during emergencies. Financial advisors preach 3 to 6 months of expenses in liquid deposits. But 6 months of expenses sitting at 0.5% interest while inflation runs hot? That's expensive insurance. The solution isn't avoiding deposits, it's strategic allocation. Emergency funds stay liquid in high-yield accounts. Short-term goals use time deposits. Long-term wealth? That belongs in assets that outpace inflation. Your deposit isn't an investment strategy. It's a financial airbag. Essential for survival, useless for growth. Credit is not debt. Repeat that until it rewires your brain. Credit is a financial weapon. Debt is a wound. The difference? Purpose and mathematics. When you understand the three sacred principles of lending, repayability, maturity, and cost, you transform from prey to predator in the financial food chain. Repayability means the loan must generate sufficient cash flow to service itself. A mortgage on a rental property paying $1,200 monthly while costing $800 in debt service? That's intelligent credit. A $50,000 car loan on a vehicle depreciating 20% annually. That's financial suicide dressed in leather seats. Maturity refers to time horizons. Short-term credit, credit cards, payday loans, carries explosive interest rates because the lender assumes maximum risk. Long-term secured credit, mortgages, business loans, offers lower rates because collateral reduces uncertainty. Cost is the complete picture, not just the advertised rate. The total cost of credit, or TCC, includes fees, insurance, and hidden charges that can double your effective interest rate. Let's dissect the anatomy of modern credit. Consumer loans, personal loans, auto financing, credit cards typically carry 10 to 25% annual interest. They're designed for immediate gratification, delayed pain. Mortgages, however, often run 3 to 7% because the collateral, real estate, historically appreciates. This is the fundamental asymmetry. Good credit buys appreciating assets or income streams. Bad credit buys depreciating liabilities disguised as lifestyle upgrades. Then there's the repayment structure war. Differentiated payments start high and decrease over time. You pay more principal early, less interest overall. Annuity payments stay flat, front-loading interest, back-loading principal. Banks love annuities because they maximize interest income while appearing affordable through consistent monthly bills. Smart borrowers choose differentiated when possible, especially for shorter-term loans. The mathematics are brutal. On a $300,000 mortgage at 6% over 30 years, annuity payments cost you $347,000 total. Differentiated structure? $329,000. That $18,000 difference is a luxury car, paid simply by understanding payment architecture. This isn't about deprivation. It's about optimization. Every dollar saved on interest is a dollar working for your future instead of the bank's quarterly earnings. Beyond traditional banking lies the credit underworld, microfinance organizations promising instant approval at 300% annual interest. These aren't lenders. They're financial predators feeding on desperation. When traditional banks reject you, these sharks circle. They bypass credit history checks because they don't care about your future. They care about your panic. The minimum payment trap is their favorite weapon. Pay just 2% of your balance monthly while they charge 24% annually. The mathematics of doom. A $5,000 balance with minimum payments takes 22 years to clear, costing $12,000 total. This isn't banking. It's financial servitude with paperwork. Your credit history is your financial reputation score, a 3-digit number determining whether you rent apartments, get jobs, or pay double for car insurance. Credit bureaus, Experian, Equifax, TransUnion, track every payment, every default, every inquiry for 7 to 10 years. One missed payment can drop your score 100 points, costing thousands in higher interest rates over a lifetime. But here's the manipulation. You have the right to dispute errors, negotiate removals, and demand validation of debts. Most people don't know this, so collectors bully unchallenged. When debt buyers purchase your defaulted loan for pennies on the dollar, they often lack proper documentation. Challenge them. Demand proof. The law requires it, but silence forfeits your power. Then there's the debit versus credit card psychology. Debit cards spend money you have, limiting damage to your current balance. Credit cards spend money you might have, creating a dangerous illusion of wealth. But credit cards offer protection, dispute rights, insurance, rewards. The trick is behavioral. Treat credit cards like debit cards. Never purchase what you couldn't buy with cash today. Automate full balance payments. Transform the bank's weapon into your tool for cashback and credit building. The card isn't the problem. The psychology of the hand holding it is. Now we assemble the machinery. Your personal financial plan isn't about choosing between deposits and credit. It's about orchestrating their interaction. Stage 1. Liquidity Fortress. Maintain 3-month expenses in a high-yield savings account, your financial immune system against job loss or medical emergencies. This isn't investment. It's survival infrastructure. Stage 2. Inflation Shield. Once your emergency fund is saturated, excess cash flows into inflation-resistant assets, index funds, real estate, treasury inflation-protected securities. Your deposit account becomes a transit station, not a destination. Stage 3. Strategic Credit Deployment. Good debt, mortgages on cash-flowing properties, low-interest business loans, education financing with ROI analysis, accelerates wealth building faster than saving alone. Bad debt, credit card balances, consumer loans for depreciating assets, payday advances, destroys compound interest working in your favor. The litmus test. Does this credit purchase something that appreciates or generates income? If no, pay cash or skip it. Stage 4. The refinancing weapon. As your credit score improves and markets shift, refinance high-interest debt into lower-rate vehicles. A 19% credit card balance transferred to a 0% introductory card, then paid aggressively. A 7% mortgage refinance to 5% when rates drop. This isn't cheating. It's optimization. Banks use algorithms against you. Use mathematics back. The final component is temporal awareness. Deposits serve immediate to medium-term horizons, 0 to 5 years. Credit serves strategic leverage, 5 to 30-year wealth building. Never confuse their domains. Emergency money stays liquid. Growth money gets deployed. Credit buys time and assets, not toys and convenience. This is the architecture that separates the wealthy from the working poor. Not income level. Financial engineering sophistication. Understanding the mechanics is useless without mastering the psychology. Behavioral economics reveals why we sabotage ourselves. Hyperbolic discounting makes $100 today feel more valuable than $150 in a year, even though that's 50% annual return. Loss aversion means we feel pain from $100 loss twice as intensely as pleasure from $100 gain. This asymmetry drives panic selling of investments and desperate credit card usage for emotional relief. Mental accounting tricks us into treating money differently based on source. Tax refund. Free money, spent frivolously. Salary. Hard-earned, hoarded rigidly. Banks exploit this with buy now, pay later framing. It sounds like deferral. It's actually debt with marketing makeup. The anchoring effect makes us fixate on monthly payments rather than total cost. A car salesman quotes $400 monthly instead of $45,000 total, and we agree because the number feels manageable. Over 72 months, that's $28,800 in payments plus interest on a depreciating asset. The solution is mechanical discipline. Automate savings before you see the money. Use separate accounts for different mental buckets so your brain perceives boundaries. calculate total cost of ownership, not monthly payments. When considering credit, calculate the total interest paid and visualize that as physical labor hours. That $2,000 interest on a vacation loan. At $25 hourly wage, that's 80 hours of your life traded for memories that fade faster than the payments. Willpower is a finite resource. Don't budget with discipline alone. Build systems that remove choice. Direct deposit splits. Automatic investment transfers. Credit card auto-pay in full. Your future self is tired, stressed, and impulsive. Build bridges for them today while you're rational and planning. You've just absorbed the operating system of modern wealth. But information without action is entertainment, not education. Here's your immediate mission. Open your banking app right now. Check your current deposit interest rate. If it's below 4%, you're bleeding purchasing power. Research high-yield alternatives this week. Then audit your credit, pull your free report, identify every debt, calculate the total interest you're paying annually. That number is your financial enemy's budget. Now plan its destruction. Subscribe and hit the notification bell. Comment below with your current deposit rate and biggest credit question. I read every comment and build future videos from your specific battles. This channel isn't about my theories. It's about your financial transformation. The Matrix has shown you the code. Now rewrite your future. See you in the next video.